Ladies and gentlemen, if you are holding physical silver right now, whether it is in your hand, sitting in your safe, stored with a dealer, or locked away in a private vault, you need to understand something very important. You may be standing directly in the middle of one of the most intense liquidity battles the silver market has seen in years. Not next quarter, not someday in the future, right now. And the question I want you to keep in the back of your mind as we go through this entire breakdown is simple. Why would the largest banks and commodity desks in the world benefit from ordinary silver holders selling their metal before the market opens on Monday? I am not going to fully answer that question yet, because to understand the answer, you need the full picture. You need to see what happened in the vaults. You need to understand what is happening in Asia. You need to understand why institutional analysts are suddenly using price targets that would have sounded ridiculous just a year or two ago. And most importantly, you need to understand why the paper price of silver and the real-world physical market may be sending two very different signals. As of Friday's close, silver is trading around $70 per ounce on the spot market. To the average person watching mainstream financial media, that sounds expensive. They hear $70 silver and assume the move has already happened. They assume it is too late. They assume silver has run too far, too fast. But that is exactly where most people may be missing the real story. Because in the current macro environment, with industrial demand rising, physical inventories tightening, Eastern markets paying a premium, and global reserve currency dynamics shifting, $70 may not be the ceiling. It may still be a discount. To understand why this weekend matters, we need to zoom out. 18 months ago, silver was still being treated by many analysts like an afterthought. The mainstream argument was that silver was overvalued relative to gold, that the gold-to-silver ratio justified the discount, and that any move higher would eventually fade. Then the market started to change. Solar demand began exceeding expectations, electric vehicle manufacturers accelerated procurement, industrial users began competing with investors for the same finite physical supply. At the same time, quiet accumulation continued across China, India, and other Eastern markets while Western media barely paid attention. By mid-2025, silver had broken through 50. By late 2025, it had pushed through $60. And now, with silver near $70, the market is entering a zone where every new data point matters. This is not just about chart patterns. This is not just about sentiment. This is about physical supply, institutional positioning, and whether the price being quoted on Western exchanges is still accurately reflecting the true marginal demand for real metal. The most important data point from Friday's session was not the closing price. It was what happened inside COMEX registered silver inventories. According to the numbers being discussed across the commodity market, registered silver inventories declined by approximately 23 million ounces in a single Friday session. 23 million ounces, that is not a small move. That is not something serious investors should casually ignore. And it is especially important because we are talking about registered silver, not just eligible silver. Here's the difference. Eligible silver is metal sitting inside approved COMEX vaults, but it has not been formally made available for delivery against futures contracts. Registered silver is different. Registered silver is the pile that is certified deliverable and available to meet futures delivery demand. So, when registered inventory drops sharply, that matters. It tells us something about the pressure inside the physical delivery system. It tells us that real metal, not just paper contracts, is becoming central to the story. A 23 million ounce registered drawdown represents a meaningful share of annual global mine production moving out of the deliverable category in a single session. Now, could some of that be reclassification? Yes. Could some of it be administrative movement? Yes. But when you combine a large single-session drawdown with weeks of persistent inventory pressure, rising global demand, and widening international premiums, it becomes much harder to dismiss the entire move as routine bookkeeping. And here's what makes it even more interesting. While this was happening, most of the mainstream financial press was focused on geopolitical headlines, Federal Reserve commentary, and broad market noise. Very few outlets led with the COMEX silver drain. Very few connected it to the larger structure of the market. And that disconnect between what the data is showing and what the mainstream narrative is covering is exactly where risk and opportunity can appear. Now ask yourself this. If 23 million O's of registered silver just moved out of the deliverable pile, why did the spot price not explode higher immediately? That is the key question, and the answer tells us a lot about how the modern silver market actually works. Because silver is not only traded as a physical commodity, it is also traded through a massive paper market made up of futures, options, derivative swaps, and institutional positioning. In the short term, the paper market can overpower the physical signal. It can delay the repricing. It can absorb panic. It can create the appearance of stability. But that does not mean the physical signal disappears. It just means pressure continues building beneath the surface. Now let's add the next piece. Reports have been circulating about a serious disruption tied to a major silver-producing operation connected to Glencore's activity in Kazakhstan. Early numbers being discussed suggest that millions of Oz of future silver output could be affected. I want to be careful here because early commodity disruption reports can change as more official information becomes available. But the broader point is this. In a market already dealing with tight physical supply, even a moderate disruption can have an outsized impact. Silver supply is not like turning on a faucet. You cannot simply raise prices and instantly produce more silver. Mine development takes years, permitting takes years, new production takes years, and most silver does not even come from primary silver mines. A large percentage of global silver supply is produced as a byproduct of copper, zinc, lead, and gold mining. That means silver supply is often tied to the economics of other metals. If copper or zinc production decisions change, silver supply can be affected even if silver demand is exploding. This is one of the most misunderstood parts of the silver market. People say higher prices will bring more supply, and eventually that is true, but eventually can mean years. It does not mean Monday morning. It does not mean next month. It does not mean supply suddenly appears the moment a chart breaks out. So, if physical demand is rising now and supply cannot respond quickly, but pressure has to show up somewhere, it can show up in premiums, it can show up in vault drawdowns, it can show up in delivery stress, it can show up in sudden price gaps, and sometimes it shows up in all of those places at once. That brings us to Bank of America. This week, Bank of America's commodity research has been widely discussed because of a silver price target that would have sounded outrageous not long ago, $300 per Oz. Now, before anyone gets carried away, let me be very clear. A price target is not a prophecy. It does not mean silver goes to $300 next week. It does not mean a straight line higher. Does not mean there will not be violent corrections along the way. A major bank price target is a modeled scenario based on assumptions. The important question is not whether the exact number is guaranteed. The important question is what changed in the model to make that number worth publishing at all. The assumptions appear to center around several major forces. First, accelerating industrial demand from solar, electrification, and energy infrastructure. Second, structural deficits in physical supply. Third, declining above-ground inventories. Fourth, currency and hard asset dynamics, as investors continue reassessing the long-term role of fiat currencies, reserve assets, and real commodities. Whether you agree with $300 or not, the existence of that kind of institutional research matters because it signals that silver is no longer being treated as a fringe asset. It is being taken seriously by major institutions managing serious capital. And once institutional research changes, institutional positioning can follow. That does not happen all at once. It does not always show up cleanly on the first headline, but over time, when major research desks begin modeling dramatically higher prices, portfolio managers, hedge funds, family offices, and commodity desks start asking different questions. They start stress testing different outcomes. They start treating upside scenarios as something that must be planned for, not laughed off. But the most important signal right now may not be coming from Wall Street. It may be coming from Shanghai. As of Friday's data, silver in Shanghai has reportedly been trading at a significant premium to Western spot prices, with estimates around 13. Let me put that in simple terms. If Western silver is trading around $70, a 13% premium implies a local price closer to $84 or $85. That is not a tiny difference. That is not normal noise. Premiums between regions can happen because of taxes, shipping, currency conversion, and local supply-demand conditions. A small premium is normal. A 13% premium is a message. Normally, arbitrage should close that gap. Traders should buy silver where it is cheaper, move it to where it is more expensive, and profit from the spread. That process should push Western prices up, Eastern prices down, and the premium should narrow. But for arbitrage to work, traders need available physical metal and the ability to move it efficiently. If physical silver is tight, if vault supply is constrained, if logistics are stressed, and if cross-border metal movement is becoming more complicated, then the arbitrage mechanism slows down. And when that happens, the premium becomes more than a pricing oddity. It becomes a warning signal. The Shanghai premium is telling us that the marginal physical buyer in one of the world's most important commodity markets is willing to pay more than the Western quoted price. That means the Western paper price may not be fully reflecting real physical demand. And when a market has two prices, one on a screen and one in the real world, eventually one of them has to adjust. Now let's talk about retail silver holders, because this is where the story becomes personal. Across North America, Europe, and Australia, many retail investors are reporting tighter availability at local dealers. Certain coins, bars, rounds, and mint products are becoming harder to find for immediate delivery. Some products are backordered, some dealers are quoting meaningful premiums over spot. And the question retail buyers are asking is obvious. Are dealers actually out of stock, or some of them holding inventory back because they expect higher prices? I want you to tell me what you are seeing. If you believe dealers are sitting on product and waiting for better prices, type hold in the comments. If you believe the shelves are genuinely empty and supply is truly tight, type empty in the comments. I want to know what is happening on the ground, because viewer reports can sometimes reveal stress in the physical market before it shows up in official data. Now let me be balanced here. There is a strong counter-argument to the bullish silver case, and we need to take it seriously. Silver has a long history of massive spikes, followed by brutal crashes. In 1980, silver ran dramatically higher during the Hunt Brothers episode before collapsing. In 2011, silver approached $50 before reversing sharply. Critics will say this time is no different. They will say COMEX inventory movements can be reclassifications. They will say the Shanghai premium reflects local conditions. They will say bank price targets are marketing, not analysis. And honestly, some of those concerns are valid. Silver is volatile. Silver can punish late buyers. Silver can drop fast when leverage unwinds. And anyone telling you there is no risk is not giving you serious analysis. But here's where I believe the current setup is different from previous episodes. In 1980, silver's industrial profile was not the same. In 2011, the solar electrification demand story was not nearly as developed as it is now. Today, silver is not just a monetary metal, it is an industrial metal tied directly to solar panels, electronics, electric vehicles, batteries, grid infrastructure, and the other broader energy transition. That does not eliminate downside risk, but it changes the foundation of demand. This is why I do not view the current silver move as only a speculative mania. There may be speculation involved. There is always speculation when prices run, but beneath that speculation, there appears to be a real structural issue. Demand is rising, supply is slow to respond, inventories are under pressure, Eastern markets are paying premiums, institutions are revising models, and paper shorts are sitting in a market where physical delivery matters more with every passing week. So, now we can return to the question from the beginning. Why would the largest banks and commodity desks benefit from physical silver holders selling before Monday morning? The answer is incentive. Large institutional players often carry significant short exposure in futures markets. That does not automatically mean something illegal or conspiratorial is happening. It means they have positions, hedges, and books to manage. But when a commodity with large paper short exposure starts experiencing physical tightness, the risk profile changes. If enough buyers demand physical delivery instead of cash settlement, shorts can become harder and more expensive to manage. The easiest way to relieve that pressure is for physical metal to come back into the market. If retail holders sell, if sentiment cools, if panic replaces conviction, if dealers receive new supply from the public, that helps ease stress. It gives the market breathing room, it gives shorts time, it reduces the immediate pressure of tight physical supply. That is why this weekend matters. It's not because someone has a magic crystal ball from Monday's open, it's because sentiment, physical supply, and institutional positioning are colliding at the same time. If short covering accelerates into Monday and physical demand remains firm, silver can move sharply higher. If retail sentiment breaks and enough physical holders rush to sell, the pressure could ease and the market could cool. Either outcome is possible, but serious investors do not wait until after the move to understand the setup. They study the data before the crowd catches up. And this is where I want to say something important. Information is valuable, but only if you know how to use it. Watching markets is one thing, understanding markets is another, and actually building wealth from markets requires skill, discipline, research, patience, and a framework. That is exactly why I created Wealth Academy. Inside Wealth Academy, I share exclusive weekly videos breaking down the exact stocks I am buying, the market research reports I am studying, the sectors I believe have the strongest long-term potential, and the strategies I use to think like a top investor instead of reacting like the crowd. It is for people who want to level up, learn how serious investors think, and build the foundation for generational wealth. Start building the knowledge and skill set now. It's linked in the description. To close this out, here is the bottom line. Silver is entering one of the most important moments we have seen in years. A major COMEX registered inventory drain, reported production disruption concerns, institutional price target revisions, a major Shanghai premium, and growing stress in physical availability are all pointing toward the same conclusion. The silver market is changing. It may not move in a straight line. There will be volatility, there will be pullbacks, there will be fear, hype, confusion, and noise. But underneath all of that, the structural story is becoming harder to ignore. If this breakdown helped you understand what is happening beneath the surface, make sure to give this video a thumbs up, subscribe to the channel, and turn on notifications, and I will see you in the next one.